Right. Welcome everyone to the 2025 Confido Tax Planning Update. We'll get our slides on the screen here and kick us off. Okay, so hopefully everybody can see the slides here on the screen. This is our inaugural Confido webinar and also our first of the year. I'm excited for everybody who's joined us. I'll give us the quick disclaimers here to keep the attorneys happy. And then we'll jump into some introductions. So let me welcome Ryan Drake to the webinar. Ryan is the Director of Tax Planning and Preparation at Mariner. He has his bachelor's and his master's from University of Kansas, certified public accountant, and he's been a joy to work with so far. So Ryan, thank you very much for joining us.
Yeah, thanks for having me. I'm looking forward to this.
And then also we've got Richard Goolsby on the call too. I didn't have enough time to get Richard a slide. He was a late entrant, but very thankful to have him here. He's actually the CPA that most of us will be interfacing with on an ongoing basis for tax prep. So Richard, thank you for joining as well.
Yeah, absolute pleasure.
Appreciate it. All right, so let's jump right into the content. So kicking off, we want to take a little bit of a step back before we look forward. So all of the sort of tax debate that's going on right now, it really centers around the end of the Tax Cuts and Jobs Act and a lot of the proposals that the Trump team has put forward, both in the past couple of days, but also on the campaign trail itself. So taking a look at the TCJA to start is a good place to begin. So this started, back in 17, and for most households, it lowered taxes. The tax brackets, went down, between 1% and 4%. The standard deduction went way up, while other deductions went away, specifically, SALT and miscellaneous itemized deductions. It made huge changes to the alternative minimum tax, AMT, such that really only a very, very small group of people get impacted by it these days. And then it also created this Section 199A pass-through deduction, or the QBI deduction, qualified business income deduction, which has been super useful and valuable for our business owners. And then past that, the other really big implication was the doubling of the gift tax and estate tax exemption. So a lot of the estate tax issues at the federal level, at least, that people were concerned about, for the most part, went away. However, that is all set to expire on December 31st of this year, right? So that is why we are uh, uh, things are heating up in the political landscape, right? So this is where we are, right? At the very beginning of next year, end of this year, it is set to sunset. So let's talk a little bit about the legislative landscape. This is not your typical Republican trifecta, right? House, Senate, and the Oval Office. In the Senate, we've got 53 Republicans, 47 Democrats, including two independents. Cabinet nominees are and all those confirmations well underway. In the House, it's a 218 to 215 margin, with two vacancies currently. Republicans will likely have 217 to 215 through April. So although it's the red wave happened and the Republicans control government per se, there's very little room for defection, right? Either way, right? It's a lot tighter than, say, a true sweep, right? So we need to keep an eye on that. The other issue is that it's different now, right, from an economic perspective than it was back in 2017. The yield on 10-year government bonds was 2.45% back then, right? And so today, sitting at right around 4.61, if we're having sweeping tax changes that are ultimately will help have us running out of a deficit for the foreseeable future, it's a little more expensive than it was. So there's a lot of sort of fiscal hawks out there that are eyeing that. The other piece is inflation had been fairly tepid since the great financial crisis. Into 2017, at that point, we're working hard to get above 2% for a long time. But we're coming off the back of the highest inflation bump we've seen since the 70s and 80s, and that is very fresh in people's minds, right? And voters do not like inflation, right? So a lot of the proposals in terms of reducing tax rates across the board, as well as the tariff issues, and then ultimately the immigration policy, all of which are fairly inflationary, according to most economists. And so there are those wins out there that we need to be aware of. So when it comes down to how this thing actually gets done or how the sausage gets made, it's going to really come down to whether this is a one bill or a two bill approach, right? Because Trump is essentially trying to tackle both tax and border control at this time. And so if it ends up being one bill, most prognosticators think we'll see a bill in spring or early summer. If they go for a two bill approach, it's going to come down to the wire towards the end of the year before that Tax Cuts and Jobs Act, sunset deadline of the 31st of this year. It'll have to go through reconciliation in terms of passing the tax changes, which means it's got to be budget neutral, right, over a 10-year period. Uh, uh, you know, Ultimately, what that means is that every tax increase needs to have a corresponding, or every cut rather needs to have a corresponding increase, or we'll end up with another situation where it's going to sunset, down the road, and we'll be back at this, in the not too distant future. So uh, ultimately, we're probably looking at, Tax Cuts and Jobs Act replacement more than just an extension, right? It's not going to, we're not going to be able to just extend the current law. It's going to have some changes that go along with it. Where's the wiggle room? What stays the same? That's what we'll get into today. Right now, there's a 51-page list of options that the House Budget Committee is looking at. So there's a lot here, right? A lot of things that can happen between now and the end of the year. We're going to focus on what we sort of have on the table now and what we're aware of. But of course, we're going to keep a close eye on this. So, Ryan, Richard, any comments, feedback, that you guys have on this first section in terms of the landscape?
Yeah, I think just a general overarching thought on tax policy through the years and why this is a fun and friction-filled conversation for many. There's going to be a lot of noise. There already has been a lot of noise around potential changes and potential wholesale movement. Things like we're getting rid of the IRS, we're getting rid of federal income tax. Maybe, probably not, probably strongly not, but who knows? Crazy things happen in Washington, D.C. But there's also going to be some movement. The way that our country has addressed major items of political change or headwinds or global pandemics in the prior few years that we've lived through have had a large impact on tax policy. Over the last 15 years, we've accelerated major tax policy changes, and it remains one of the top focal points. When you bundle all of that together with the expiration of a massive tax change, which is the TCJA, no political party really ever benefits when the other side gets to say you're the party that raised taxes across America, especially on the working class. There will be movement. We don't exactly know what that movement is, but being prepared for it, staying in communication and listening to the noise and planning fluidly through it will be important to keep in mind as we go through the following slides.
Yeah, trying to find that signal through the noise. Thank you, Ryan. Okay, so let's jump into personal income tax considerations. This section will impact everybody, right? So, what do we think is likely to stay the same? Well, the tax brackets themselves, right, are likely to stay the same. And I think, part of, what Ryan was touching on earlier, nobody wants to be the party that raised tax, rates, in earnest on the population. So it's likely that will stay, where it is. The higher standard deduction also is likely to stay in place. And part of that staying in place is this elimination of personal exemptions. So just kind of comparing where we were versus where we are. So this is the current tax rates over here, 2024. And then to the right, you'll see if it goes back to what it was before post TCJA. So if we don't get a change, right? If the Tax Cuts and Jobs Act just straight up sunsets at the end of this year. And just to give you an example, I mean, look at a single filer, right? 100,000 to 191,000 is taxed at 24%, right? If it sunsets, right, effectively one half of that amount of income isn't taxed at 24. It's taxed at 28 and a good chunk at 25, right? So pretty significant difference, right? And you can follow that line of logic, all the way down. The trust tax rates, not a huge difference. The highest level is slightly higher, but the amount of income that a trust earns, you're taxed perniciously, under either one, and you got to get that income out if you can. And we can see here the standard deduction, right, for a single person 14.6 versus what it used to be at 78.50 with the personal exemption. And then married filing jointly. Again, we think that those things are probably going to stay the same, but it's the tax rates, again, likely to stay the same because they are just that different at the individual level. So one of the big ones is SALT. So SALT stands for state and local taxes. This is a place where there's a very high likelihood that something's going to change. There have been a lot of different things floated out there. Option one, raise that cap or eliminate it entirely, right? And this is sort of where we were before, right? Where your salt was unlimited. Um, a lot of people pointed back in 2017, that this was like a finger in the eye of the coastal elitists, right? Where, property taxes being a huge part of your SALT deduction, getting taken out, was certainly impacted folks, in my region, sort of here in the DC metro region. Um, but raising the cap or eliminating it would certainly be helpful. Another option is doubling it for married couples and then tying that to inflation. So going from 10 to 20 for married couples, and then attaching COLA. Option three that's been floated is a plan that, sort of only to property tax, which, again, coastal elitists, we'll have to see where that ends up. And then option four is eliminating that deduction altogether. We'll have to see where it ends up. I think that the, option one or two is there's very high likelihood and a lot of push behind that. It is expensive though. So from a reconciliation perspective, if you do, eliminate the cap, you've got to find a way to cover it. And I guess right now that's tariffs. But we should see some movement. There's some real implications as it pertains to alternative minimum tax when it comes to the SALT deduction. Right now, really not the only people, but primarily the people who are paying AMT are those with incentive stock options that are exercising those stock options and recognizing the bargain element. It doesn't hit a lot of people, but if it does change, a lot more people will find themselves back in that AMT range. And so we're going to talk a little bit more about that here in a second. Um, the other piece is that the increasing the cap could start to wind down the pass-through entity workarounds. And so Ryan and Richard, I don't know if you guys want to speak to this, but a lot of business owners have found a way, to get their state and local taxes deducted through their entities.
Yeah, so what Sam's referring to is something that lovingly is called PTE or PTET, pass-through entity tax. And it took the states a while. There were a lot of iterations that I won't bore you with the history and the development through the years on this. But in states' efforts to get their citizens and residents around those $10,000 SALT limits, they finally settled on an ability that the IRS has blessed and said, well, entities can pay this. And so what they've come up with is a way for the entities to be hit with the state taxes through an election to where the partners on these entities and the shareholders will pay basically a flat rate in many instances to simplify the discussion at the entity level. And then they will get a credit on their personal return that offsets their normal state liabilities. This is a workaround that is good for taxpayers because it reduces the ordinary income flowing out from the entity that's now paying those SALT taxes, and it avoids the Schedule A, which is the itemized deduction, which is where the SALT limit of 10,000 exists. So it's the workaround because the entity gets lower income being pushed out to the individual as a result of paying those taxes. It never has to show up on Schedule A, so it is not limited. The item I'm curious about, because I've been wondering for a few years on if these programs will dissolve or if they'll stay around. I think we will see them linger and continue if AMT is not addressed. And the reason for that is if it's not a SALT deduction on the Schedule A, it won't be an add back on Schedule or Form 6251, which deals with alternative minimum tax. And so those PTEC credits could actually stick around and be useful for taxpayers that are avoiding AMT. Now that's speculative, of course. They could find a way to patch that and just say, well, at the state level, it's an AMT adjustment on these forms and it goes into your K1s. I don't know yet, but currently they're not an add back for AMT. And so it could be a good workaround for the alternative minimum tax, even though SALT caps go away.
Yeah, we'll have to see where those AMT limits end up if they stay where they are. There's a lot of room, but yeah, absolutely, that's a huge implication. The other thing I think about is charitable giving, right? I mean, a lot of people right now just don't benefit from giving to charity because the standard deduction is so high, and
Sure.
really you only itemize if the combination of your state and local taxes capped at 10,000 plus your mortgage interest, right? And in some cases, there's other ones that flow in there like investment interest expense and things of that nature, medical expenses. But for most people, it's really mortgage and 10 grand, right? And you're trying to figure out if that's higher than the standard deduction. In a lot of cases, it's not. And so, ultimately, if we have a big expansion of SALT, charitable giving will become more beneficial for more people, at least from a tax perspective. So interesting thing to keep an eye on as well. Um, so yeah, so other itemized deductions, mortgage interest indebtedness, the limit was cut down to 750,000 in the prior bill. It was at 1 million plus 100,000 for home equity lines of credit or improvements. Um, Other miscellaneous itemized deductions, reinstating those like investment advisory fees and financial planning fees would be wonderful, for me and all the clients. So we'll have to see where we end up there. And then Trump also campaigned on, having auto loan interest become an itemized, deduction, which, again, for a lot of people would make a big impact and probably be good for the auto industry as well. So, they're all on the table. We'll have to see where they end up. But all three of those would be wonderful from where I sit. The child tax credit is another thing that's on the table, right? So current max is 2,000 per qualifying child. The phase out threshold would reduce from 200,000 for a single person, 400,000 married filing jointly, to 75 and 110, right? And so that phase out would impact a lot more people and sort of reduce the benefit of the current tax credit that they're getting for children. Um, the Trump campaign proposed increasing it to 5,000. However, other Republicans in Congress have floated legislation to increase it to 3,600. So we'll have to see. We may end up with a higher credit, but with ultimately a lower phase out, which for our high income earners, would impact them, in a negative way. So we'll have to keep an eye on the child tax credit for everyone with kiddos. And then AMT, right? So, we were talking about this a bit before, but if you look at the bottom here, you can see that, right now the AMT phase out threshold, right, for a married couple, right, which is, where you start to phase out this exemption that you're given, is $1.2 million. That used to be 199,000, right? So, I mean, it's a huge difference in terms of when this phase out it starts to eat into your exemption, right? And so the exemptions, it's a bit higher than it used to be, but the real sort of magic here is this this phase out threshold. And so there's a lot of planning to be done here, particularly if you have incentive stock options. And so Ryan, Richard, if you guys want to speak to that a little bit, that might be helpful here.
Sure. So AMT, as Sam is explaining, the exemption phase out threshold change is huge. It allows us to have less AMTI, which is alternative minimum taxable income, that goes against the standard rate that then gets compared to your ordinary tax and determines if you're an AMT or not. Because that exemption has been so high and because we've eliminated things and deductions such as SALT and those 2% fees that Sam alluded to earlier, we don't have as many add backs to AMTI, increasing the base that alternative minimum tax is applied to. If that exemption lowers, if we increase the amount of add backs from Schedule A and the 2% fees or the SALT, either way, we're going to shove millions of more people into AMT. When we think about the items that Sam is highlighting here in incentive stock options or AMT carryovers, it's kind of in many ways two sides of the same coin. An incentive stock option is important to think through, and I won't go into all the mechanics, but what it does is it creates an adjustment to AMTI. There is a phantom tax in AMT that is applied even though you don't have a federal income when you exercise these options. If you have those, if you're familiar with them, you know as well when you generate a tax, it creates a credit carry forward. It's basically prepaying your federal taxes. The problem that exists for taxpayers is that that credit can only be used in future years when regular tax exceeds AMT. And so you're always in this balancing act of, do I exercise more incentive stock options this year and drive up AMT and pay it and create more carry forward? Or is it a good year to utilize my prepaid taxes as credits against regular tax and hold on to those ISOs? It is a deep balancing act. That gets further compounded, of course, when we talk about, well, what kind of drivers go into AMTI? Exemption going down, deductions being added back. That leaves us with the point here on this slide is if we think that that's going to happen and it looks likely that AMT will be negatively impacted or more people will experience AMT going forward, it could be a good year to halt exercising ISOs It has to make financial sense. You never want tax to be the reason you make the ultimate decision. It is an important factor, but shouldn't be the only reason to make a financial decision. But if we think that's the case and it's okay to hold off on exercising, maybe it's best to use our carryovers up now because in the years to come, it could become harder to access those as more people trip into A&T. That was a lot, Sam. So if you want me to rewind that in any way, I'm happy to dive into it deeper. It's a complicated subject that I'm trying not to lose people on.
Yeah, no, I think you did a good job, man. Yeah, I mean, like ultimately, the like long story short is if things sort of go back to the way they were, it's going to be a very narrow sort of calculation between years where you have AMT and you don't. Right now, it's really wide, right? And so, it's a higher likelihood that you could use your, an AMT credit this year than you might in the future. And that has big implications, especially as equity compensation has become more and more common, especially in like the tech space. And this impacts more people. And just like by way of background, you may or may not know it, but every year when you do your taxes, there's a calculation that's run in the background that is comparing your what you're paying for federal taxes versus this alternative minimum, right? Where most people never see it or they haven't in a long time, but it's there, right? And so I think we'll be hearing more about it as we move forward. So thinking of other proposals, we've had a lot of them, but some of the highlights, right? Eliminating taxes on tips and overtime wages, eliminating tax on Social Security income, and then eliminating income tax in the IRS, right? Eliminating tax on Social Security, this would be huge for our retirees, obviously. In most states, or not most states, but many states, it's exempt from state income tax, and most people end up, your Social Security it's either 50% of it's tax free or 15% of it's tax free, and that threshold is fairly low. So most people end up with 15% of their Social Security being tax free, sort of to begin with. But this would be huge. It would be expensive, right, at the federal level to do that. But this would be a big deal for our retirees. On tips and overtime, this is you know the tips thing is hard, right? Because I mean, if you know anybody or have, friends that work in, or you've worked in the service industry, you know that sort of how much you've recognized in tips in a given year is more art than science. So eliminating the taxes is kind of an interesting thing. It'd be interesting to see what the impact really would be. But overtime wages, I mean, that would be huge for a broad swath of America, right? That is, working shift hours and, putting in extra time. And so I think from putting money, back in the pockets of the working class, that would make a huge impact. Eliminating the tax in the IRS, we're already showing a pretty significant 10-year deficit on just the current proposals. There would to offset that, right, the tariffs would need to be so high. I you know I don't know if either of you guys want to opine on this at all, but or maybe just explain like what would need to sort of happen for to
Sure.
eliminate income tax and still have a country that could pay.
Yeah. Well, um, I think this could be a fun conversation, but I think the short version of it follows something similar to this. If I were to boil this down into one concept, as I have many times through the years when my friends and colleagues come to me, they're like, yeah, but what about a sales tax to replace it? You show me a government, any government, I won't pick on ours. You show me a government that can give you a balanced budget year over year and never want to expand it with arbitrary is a strong word, but tack on programs. Sure, we can talk about doing this. The other thing I would say, and Richard, Sam, and I joined a little bit early on this call, and we were talking through this particular point a little bit, and we specifically around Made in America as a concept, right? And Richard said, well, I don't think anything is truly 100% made in America. It's assembled in America, but the parts come from all over. So no matter what we do, I think we can tariff the heck out of anyone, right? But if we tariff them, that part's going to get more expensive. You might eliminate the income tax, but you're driving up CPI, you're driving up cost of product, it's all going to be really, really difficult. So as I look at these three or four initiatives right here, Social Security is the one that probably makes the most sense for them to address, but I would probably see it more in a FICA match, right? Like maybe we raise the FICA wages and we don't cap that any longer to pay for this, but it's going to have to substantial pay offset. Eliminating income tax in general, I just don't think that our history in this country over the last 200 years does anything other than tack on more income tax. So I just don't see that possible.
Yeah. Yeah. I mean, tariffs are in effect a tax. I mean, at the end of the day, right? Because the citizens are paying more, right? They're just not paying it to the treasury, per se, right? So,
Sure.
um, interesting proposal. We'll have to see. All right, and then some other, proposals that have come out, repealing all or some of the Inflation Reduction Act, very, interestingly named act, including tax credits on solar panels, energy efficient upgrades, electric vehicles. They've also talked about eliminating head of household filing status, which I think is, just kind of mean. But that's, neither here nor there. And eliminating that, business SALT deduction, right? That PTET that Ryan was talking about, a little bit ago. Um, so, just moving forward a little bit before we get into business owner stuff, what will not sunset, right? So, the corporate tax rate, it may go down. We'll talk about that here in a second. The ability to recharacterize Roth conversions later in the year, that's not sunsetting. Repealing the Affordable Care Act penalty for not being covered, that's not sunsetting either. Um, Alimony payments used to be taxable and deductible if made before 2019. That's not set to sunset. That's not changing. 1031 exchanges or like-kind tax-free exchange is limited just to real estate. That'll stay the same as well. And then the repeal of moving expenses being deductible, that'll also stay in effect, with the exception of, active duty military. So with that, before we move on to business owner, tax considerations, as you guys are looking at all these proposals and sort of all the stuff that's out there in the ether, um, what do you think are the most important things to highlight or actionable strategies or just things to be considering, from a personal income tax perspective?
Yeah, that's a great question. I think in the interest of time, I'll shorten it. And then if we have time at the end, we can come back and either address some questions or highlight it a little bit more. But to me, this all boils down to an effective tax planning strategy session with Sam or with us or with anyone in the future. Really comes down to being able to be flexible. We want to stay attuned to the likely to change things, and we always want to make use of the currently enacted known items. So when we think about real estate taxes assault, that has been noisy since it passed with the TCJA. We have found some workarounds, but I would temper expectations on enjoyment out of that based on what we do with AMT, right? So maybe if they change that, that's going to be great for a lot of people, unless they don't fix the AMT exemption that will sunset and go back, or they don't eliminate AMT or fix it in some other way. We're going to find out that we're paying taxes just in a different way, and they're still not giving us that much benefit. So instead of maybe focusing on items like that, I would encourage focusing on anything that we can do with tried and true methods, which is introduce as much income into the brackets that make sense today to play rate arbitrage through the future. We always want to pay less holistically, even if it drives up tax today. So, an idea around that is Roth conversions. I'm sure most people are very familiar with those. We know it's increasing tax today, but we have a whole host of reasons, both tax related and not, that we want to get those traditional IRAs parked inside of a Roth IRA, and it can make sense to pay the tax at lower brackets, expanded brackets today than it would tomorrow. The other thing is charity, right? A lot has been made of charity, and I always go through the Schedule A and say, well, the reason we focus so much since the TCJA is it's really our only lever left to pull on a planning for itemized deductions. We really aren't rooting for you to ever have excessive medical expenses to be deducted. We can't do anything about SALT right now, for the most part. We don't really advise you to take out debt very often for a tax deduction reason. It's not the best financial sense most of the time. 2% itemized deductions are gone. That leaves charity. Just because the standard deduction goes back down or we get SALT increase, that means everyone's going to be itemizing again, or more people will be itemizing. That doesn't change a lot of the conversations around why charity is important to focus on in certain years. It remains a great tool to bunch and use donor advised vehicles, which really became popular after 2017. Those can still make a lot of sense in years where you need a big deduction and you want to pay less taxes today because you're having a large income event and you're charitably minded, even if we prorate those out through the years. So to boil all that down, be reactive, proactive in many ways, but leave a fluid plan in place that relies on tried and true things, which is tax mitigation through the years versus crystal balling what this administration will be able to pull off in the next two or three.
Yeah. Yeah, we got to play it where it lies. and that charitable bunching strategy we've been doing a boatload of in conjunction with Roth conversion. So, we
Yep.
certainly plan to keep that going. Yeah, I think, for retirees, it's, that Social Security, component is huge. The Roth conversions is huge. For our high income people, um, the SALT tax, would make a significant difference. And then for a lower income, people, that, tax-free treatment of tips and overtime, would be massive. But, ultimately the tariffs, disproportionately impact, lower income earners, as it pertains to inflation. So a very mixed bag. Now switching gears, let's talk about some business owner tax considerations. Um, One of the big proposals is cutting the corporate tax rate. So not for LLCs, partnerships, sole proprietors or S corporations, but for C corporations, down to 15% for domestic trading businesses, right? So um, when they passed the first TCJA and they cut the corporate tax rate from 35 to 21, they included this Section 199A deduction for pass-through entities, sole proprietors, LLCs, and S corps. What they did was say, okay, if we're going to cut corporate tax rates from 35 to 21, we're going to allow this 20% deduction, this QBI deduction, for pass-through entities, and it's made a huge difference, for a lot of our business owners. Now, if they cut that federal rate down to 15, right? Sort of correspondingly, the QBI deduction would, in theory, if they were to keep the same sort of spirit behind this, that would go to 35%, right? To kind of normalize the decrease in C Corp tax rates. But this is a big deal to watch for business owners. And so Ryan and Richard, thinking about like entity structure and where this comes in, how do you think about, selecting that, whether I'm a C Corp, going forward at a 15% rate? Um, what are your thoughts?
Yeah, I think the way we have always tried to approach this, great question and an important topic, right? We have always tried to approach this, again, something I said just a little bit ago, tax is never the best reason. That's not true. It's not the only reason to make a decision, right? It may be the best, but it's not the only reason. So whenever someone comes to me and says, what entity should I choose? This C Corp sure sounds good with the low rate. It really needs to be a holistic discussion with your advisor, in this case, Sam, to understand what you want out of the entity. Yes, there are tax implications for it, and hopefully they do keep QBI around and increase that rate to keep it on, create a parity with C corps. But there's a lot of reasons not to be a C corporation, including double taxation, lack of flexibility in getting assets out of it. Just the same way as there's reasons to be a partnership or a single member LLC over an S corp that's single member, right? Especially if you own real estate, not a great asset to put in an S corp, great asset to have in a single member LLC, not a great asset to have in a C corp if all you're ever going to do is hold real estate. There's just a lot of other factors that go into it. Hopefully they keep it around. I don't think this changes a lot of the other decisions we make around S corps are great to shield FICA as well. So a lot of these discussions, again, really do come back to not just QBI or tax rate decisions, but what do you want out of the vehicle? What's your main manufacturing, as an example? What's your industry that you're getting into? What's your principal product? And then QBI is a tack-on discussion. High and important, but there are other things that stay really central to planning entity formation.
Yeah, no, that's spot on. It's you don't let the tax tail wag the entity dog for sure. Um, but it'll be interesting to see. And we'll have some spreadsheets, I'm sure, that say, hey, because basically just to take a quick step back for the sort of uninitiated, when you're a C corp, yeah, you're paying a lower tax rate at 21% today, but you know, you pay that at the corporate level, and then a dividend is paid, right? And then you pay tax on that dividend as well, right? And so you end up with this double taxation situation. And we'll have to see, where QBI ends up, and if it makes sense, going forward to pay taxes at 15%, and then pay it again, as a dividend. That could end up being lower, right, than your individual rate through a pass-through entity. So definitely something we're keeping an eye on for business owners. The other big one, the two are R&D expenses and then bonus depreciation. So R&D expenses, this is a super duper complicated matter. And we have a specialty tax team at Mariner that can really dig into this for you. If you feel like you're a business owner with expenses that should qualify for the R&D expense, get in touch. We can pull them in and start to make sense of it, even if it doesn't change, even if it's amortized over 5 years. This is a very sticky part of the tax code that you really want to make sure you're getting expert help on. The bonus depreciation piece, I think this touches more people and more business owners, but essentially, in 2017 and over the next couple of years, you were able to, depreciate, lots of different things, automobiles, over a certain weight limit, but also very commonly with a lot of our clients, uh, components of a home that have under a 27 and a half year usable life. And so some people on the call may be very familiar with this, others may not. But the short-term rental loophole, as it's colloquially referred to, is a tactic that sort of high income people have been using over the past couple of years, where typically you can't deduct your losses on a rental property if your income's above $150,000. You get phased out because it's considered a passive activity. You can only take passive losses against other passive gains. The loophole that came in was essentially if you operate short-term rental, and there's very specific requirements around this. It's 100 hours a year, average stay of 7 days or less. No other individual or business or entity, offers more time and service, to that endeavor than yourself. If you meet all those criteria, then it's not considered a rental activity any longer, right? And then it can be considered active, active and material, which means you can take those deductions against all of your other active income, like W-2 income, 1099 income, pass-through business income. And so you combine that short-term, loophole with this bonus depreciation concept, and all of a sudden you're able to take a boatload of depreciation against a short-term rental property and actually use it, against all of your other active income. And so this is another section of tax planning where the specialty tax team at Mariner is super useful. We've got a cost segregation team, on staff and folks that are very familiar with this. But um, you know, one of the big campaign, sort of promises was bringing back, 100% bonus depreciation, which if that's the case, there will be a lot of opportunity, for business owners and non-business owners that are interested in having, real estate, short-term real estate as part of their overall sort of portfolio from a tax planning perspective. So really interested to see how that one shakes out. Um, Rich and Ryan, any other feedback you guys have on business owner tax planning, sort of with what we know and what we know is proposed?
I think that's really you covered some really great points, and I think I'm happy to let most of them lie. I do want to just call out cost segregation in one more way. It is most certainly excellent for short-term rentals, and it doesn't even have to be super high cost. You might say, well, I just have a portfolio of five or six $250,000 homes. Normally, a $250,000 home, I might say it's not worth the expense of that, but it could be, and we should look at that, or someone should look at that, especially if you have a portfolio of several that aggregate up to 1 million or 1.5 million. The other thing I'd say is even if you don't have a short-term rental, which we can get in the mechanics of that if anyone has a question on it. But if you've got a normal tried and true rental property and it's passive income and that means it's limited, I always advise clients and prospects to think about their tax situation as diversification strategies. It sounds a little weird, but stay with me. Just because we have this suspended loss doesn't mean it's useless to us. If we're going to sell a property that can trigger a passive gain, that allows us to utilize that loss. If we have different forms, right? That's why we push Roth IRAs and traditional IRAs. There's a reason to have both. That's a diversification tax. There's reasons to have those for tax reasons as well. So that's a diversification there. Anytime you have any kind of a carryover or a limit in one year, they can apply to a different. Those are all forms of assets that we can shift our thinking around, and depreciation is certainly one of those. So building up those passive losses could be good, even though you don't get the benefit year one.
Yeah. Absolutely. Yeah, passive losses are not like, by definition, worse than active losses, right? It just depends on the year and what you have going on. So,
Right.
certainly something, for all of us to keep an eye on. So, let's jump into estate tax consideration. So, for sort of the uninitiated, the estate tax threshold before the Tax Cuts and Jobs Act was, $5 million per person, 10 million for a couple. And a lot more people found themselves in federal estate tax trouble. And there was a lot of, planning that was done to avoid that. When the TCJA passed, it bumped those limits way up. In 2025, it's $13.9 million for an individual, 27.98 for a couple. And so whilst there are still many people who fall into that, that sort of issue, the majority of people do not have an estate, that they'd pass on over, call it $28 million. If the Tax Cuts and Jobs Act just sunsets, the inflation adjusted, limit is going to go back to roughly 6,810,000 for a single person, 13,620,000 for a couple, right? And so while we think it's likely that that these higher thresholds are upheld, absent the TCJ, sunsetting, um, it's certainly something that you want to be thinking about and planning around because, if it does change, uh, the federal estate tax rate is 40%, right, Ryan?
It is.
Yeah.
And that is something, as we talk through these, maybe you're going to hit it in a minute, but Trump has come out and said that he might want to keep the exemptions, but he might also want to keep the 40% that it goes back to. It might be 35 right now, but it reverts to 40 at the end of TCGA,
Yeah.
TCJA.
Yeah. So anything above that number, whatever it ends up being, whatever the exemption ends up being, it's taxed perniciously. I mean, it's a big number, right? So, some of the key takeaways, if the exemption is extended, right, there's less of a, sort of need to make these really large gifts into, irrevocable trusts or to family members, than, otherwise would be, right? Um, in fact, if you don't have an estate tax issue, it's a lot better to have somebody pass away and have the family inherit the asset through their estate with a step up in basis. Or in other words, instead of all the gain that was built into that asset that the individual owned, when you get a step up in basis, you inherit it, and your basis is the fair market value on the date of their passing, right? Which means you could then liquidate and sell it and move on and have no tax owed. Um, there's also gifting between generations from a multi-generational planning perspective, to from younger generations to older generations, highly appreciated assets to get that step up in basis. There's still a lot of planning that can be done sort of regardless of the exemption. Um, and it still makes sense to make the portability elections, right, to pass the exemption, double the exemption from spouse to spouse. Um, we think that there's going to be less activity around intentionally defective grantor trusts, irrevocable life insurance trusts, for shielding assets, and guess, unless again you're already above that sort of close to $30 million limit. Um, and then revocable trusts, spousal lifetime access trusts or SLATs, they can still make sense, just simply for avoiding probate and having greater posthumous control, and also, offering potentially creditor protection from, a bad spouse for, somebody one or two generations down the line. There's still a lot there, for multi-generational planning. Um, it's just the limit, may end up being extended. And then finally, don't forget the state, tax as well, right? Every state treats this differently, and you're going to want to monitor those limits, as well. So, Ryan, Richard, any other, sort of takeaways you'd offer for on the estate side?
The biggest one that I always caution people on is this may or may not happen this year. Today it is happening, right? As of 12/31/25, the ability to plan goes away if Congress fails to act. The reason I point that out is lawyers sure do get busy, and this isn't something that typically can be done overnight. And so if we wait until November to say, oh, I wonder what assets I should really give, or okay, it's now time to do this, you run the risk of not finding someone competent to draft this and get it all funded because you will have to retitle the assets into these trusts. There is a timing concern here, right? Even if we don't think something is going to be taken away from us, a lot of these plans can be started. We can identify assets. We can make meaningful steps to know what we want to do, structure it, and get it ready to go other than just signing paper. So we can leave it very flexible on implementation, but at least drafted. And I always recommend clients think through that timing risk because I do anticipate a lot of activity currently as the law sits in October, November, December through those holiday months that lawyers may be pretty scarce and hard to come by.
Yeah, I think that's great advice. these things do take time. And even if you wanted to rush it, you're going to want your own time to read your documents and have a good understanding of what you're signing. I mean, you can get an attorney to draft something up and sign it and codify it, and even then, to Ryan's point, you still got to change the beneficiaries, update the title, transfer the deeds. It's not an overnight process. So if you're anywhere, near that threshold, by all means, let's sit down.
And
Um,
sorry, one more thing, Sam, really fast. I forgot we talked about this, and I said I'd mention I didn't. Even if nothing changes in our estate plan, they extend the TCJA, the estate limits as they exist, or even if we don't have a need to worry about 13 million versus 26, if we have documents drafted from 20 years ago, 5 years ago, last year, it is always a good idea anytime conversations around this or major laws change to go back in and review those and make sure that they are worded in a way that is acceptable for the new change. Just because it doesn't necessarily change the outcome today doesn't mean it can't tomorrow. And we do always want to review those documents and make sure that it's tied to the right wording around unified credits and lifetime exemptions and setup of AB trust to make sure they get the right limitations and phase outs worked into them properly. Sometimes they are worded vaguely and not specifically enough or tied to the right section or code or updated rule to remain effective. The whole plan might still work, but this one phrase might cause a problem. So it's always good to dust those documents off every couple of years, especially in a year of a potential change, and make sure that Sam or your other advisors have had a chance to review them with you.
yeah, I think another really good example of that, having nothing to do with TCJA, is the changes in beneficiary IRA rules, right?
Absolutely.
I mean, any estate plan that was drafted, 10, 15, 20 years ago is probably not going to contain the right provisions to get a stretch, based on the nature of the beneficiaries and all the other components, either through a revocable trust that's extant or that springs from your will or is testamentary. So, um, yeah, regardless of the TCJA, this is something we want to continuously monitor and make sure they are up to snuff.
Yeah, great call out.
Yeah. All right. So other implications, right, of which there are many, we will cover a few. Um, so, tariff policy, right? I mean, essentially the plan or the plan that's been floated is to create all these deductions, and pay for them using tariffs, right? That is at the end of the day, sort of, the broader overarching plan. The Trump tax plan would decrease tax revenue by 7.8 trillion. Um, uh, and claw back 921 billion in green energy credits, another 3.8 trillion in tariff revenue over the next 10 years, right? So that's still a pretty significant deficit based on the current plan as it sits. But all those tariffs, I mean, they will cost, they will cost us ultimately in the form of some degree of inflation. Um, we've seen long-term, bond yields increase. The 10-year specifically has been sort of the most dramatic. And that's under the expectation that we're going to see, interest rates stay higher and that we're going to see more growth. Um, there was a lot of talk early on about sort of the bond vigilante camp that, saying we're all this deficit spending, the interest rate, yield curve is reflecting people being worried about, the deficit spending. I think it has more to do with expectations around growth, at this point. But ultimately, yields have risen. And so the Federal Reserve, currently the federal funds rate, let's see here, I was on a plane from Chicago. They didn't cut the rates yesterday, did they? Let's see. Federal Reserve here. This is on the fly. Let's see. Yeah, no cuts, right? So we're still at 4.25 to 4.5. We had 50, basis points in September, 25 in November, and 25 in December. We'll look at the dot plot here in a second to sort of see where we're going directionally, but we're going to see less cuts than we're, originally sort of presumed. And I think a lot of that has to do with the specter of inflation coming from the tariff policy. Mortgage rates are still, fairly high, at least through the lens of recent history, 7.04 as of January 20th. And then, of course, the plan master deportation, would increase, prices in food, construction, hospitality, and also care industries. We're looking at between 10 and 11, million undocumented immigrants. 8.3 million of those, are working, specifically in those sectors, by and large. Um, and across all, all sectors of the economy. But that's where we would likely see the biggest impact on price. Looking at the dot plot, this is where we see potential range of outcomes for 2025. But this is certainly not gospel, but you can see the majority of Federal Reserve Board governors see the federal fund rate sitting somewhere south of 4%. So maybe four and three quarter. Let's see. So for 2025, yeah, 3.75% roughly, just under four. And then by 2026, you can see the consensus is building, somewhere south of 3.5. So rates are moving down, right? It's sort of, definitely, directionally where we're going, but the pace of rate cuts, should be slower. Speaking, more about the Federal Reserve, Trump talked a lot about, firing Powell if he didn't want to play ball. His take is no, I won't be resigning, and that it's not permitted under law to be fired. So he's definitely in there and entrenched. Vice Chair for Supervision, Michael Barr, he's going to be stepping down from his role with the Fed on February 28th. He'll stay on as a governor, and choose to avoid a potential fight if Trump was to demote him. It's likely that Trump will elevate Michelle Bowman into that vice chair position. So we're going to see some moving around at the Fed, which I think everybody sort of expected based on the rhetoric and tenor, coming into the election. Another one that's top of mind is deregulation. Unwinding a lot of the Biden era regulations is top of mind. Some of the big priorities: banking, capital markets, cryptocurrency, healthcare, and then of course the environment. So, in terms of banking, uh, we're expecting lower capital requirements, more M&A, and then of course this sort of debanking that's been occurring, to kind of go away. Capital markets, we're going to see an expansion in sort of what's possible in terms of data analytics and market structure. But also climate and ESG funds are sort of on the chopping block as being non-fiduciary on a go-forward basis, with profit motive being at the center of what these vehicles' purpose, should be, and not, anything, outside of that scope. Cryptocurrency's way up there on the priority list, and this extends from, a strategic Bitcoin reserve to, just, I mean, you guys already saw it. Trump coin and Melania coin. Here we go, right? I mean, it's on. And so, keep an eye on that specifically. There's a low likelihood that we're going to see the Affordable Care Act repealed. It would be politically very unpalatable, but, deregulation in the sector is highly likely. And then environment, day one executive orders, we saw them, withdrawn from the Paris Climate Accord, rolling back the incentives, that we've seen in electric vehicles. That's going to have, huge impact on those industries. Then, last one I want to highlight just briefly, education planning. If you logged into departmentofed.gov and wanted to sign up for the awesome SAVE Save Repayment Plan, you cannot, right? It is blocked at this point, right? So if you didn't get in there before, hopefully there'll be an opportunity to do so, but it seems very unlikely as a lot of the work that Biden had done on the Save Repayment Plan was an executive order, and it can be kind of washed away. So it's likely that you'll end up in the repay plan if that's the case. Public service loan forgiveness is probably safe for current borrowers and people who are making progress. However, the future is definitely very murky. This is a shame, point blank period. But ultimately, there's a lot of planning to be done if you are, working on your student loans right now. So be in touch. And then, of course, other proposals: elimination of in-school interest subsidy, meaning that while you're in college or in school, you're not, your interest is being subsidized on your loans. End of the American Opportunity Tax Credit and the Lifetime Learning Tax Credits. Elimination of exclusion for scholarships and fellowship income. And then, of course, the student loan deduction itself, right? So lots and lots to watch on the education planning front that spans, financial planning, but also tax. And then, I'll start to wrap up here with a couple of final thoughts. Change is a feature, not a bug, in today's politics. If we look back to the 60s, 70s, 80s, and 90s, changing control of the House, Senate, or White House is just more and more, frequent at this point. I mean, this is sort of directionally, where we are and have been headed. If we look at the markets and political parties, this is Dow Jones going back to 1901 to 2024, Democratic president versus Republican Congress, so on and so forth down the line. Where we are today, Republican president, Republican Congress. the gains are basically what you see, over time in the market. Really nothing, worth writing home about. That is a pretty typical long-term performance, assumption for a diversified portfolio. In markets, of course, they reward long-term investors regardless of presidential party. So you're seeing Democratic versus Republican president, right? You're seeing, who had Congress, whether it was full Democratic, full Republican, or sort of mixed majority. A lot of this is noise when it comes to investing. If you had just been invested under a Republican president, or only under a Democrat, and you started with $10,000 in 1961 versus just staying invested, you can see the difference, right? Stay in the game and try to tune out the noise. So in summary, as we're watching the proposed legislation, individual tax brackets and standard deduction, it's a low likelihood of change there, at least the way we see it today. SALT, yes, we think there's going to be some change. We don't know exactly what it's going to be, but we do think there's going to be some change there. And then going on down the line, itemized deductions, child tax credit, AMT, QBI, Section 199A, and those R&D and bonus depreciation. We think there should be some action there. And so these are the things we really want to keep a close eye on. Estate tax, again, that's sort of in that low area with individual tax rates and standard deductions. And finally, we'll keep an eye on these other proposals that came on the campaign trail, which included tax on tips, eliminating tax on overtime, eliminating Social Security tax, and of course, reducing or eliminating the credits for solar home efficiency upgrades and vehicles. So with that, I will get us to our questions slide. The chat feature is available. If anybody has any questions, by all means, load them up there. And while we're waiting for any other, questions to come in, Ryan, Richard, just any final thoughts on, tax planning, financial planning, for 2025 based on everything we went through today?
No, I think this is a ton of content, and I want to save some time for your questions. I would just echo the sentiment of your last couple of slides. It doesn't really matter who's in the White House, who's in Congress, what combination there is. The tried and true methods of staying invested, stay active in tax, rest on the fundamentals, introduce income in the lowest rate years through time, introduce deductions in the highest rate years through time, and you are 50 to 75% of the way being tax efficient, right? Tried and true fundamentals. Some things change regularly. Tax law changes a lot the last few years. But that tried and true fundamental is where you're at. Don't think of it as 1 or 2 year event. Think of it as 5, 10 lifetime event of how I'm paying taxes over my life, not just today and tomorrow.
Absolutely. Yeah. Timeless wisdom. I think, one of the big reasons I decided to partner with Mariner, was to fully integrate, tax, specialty tax, estate, you know, business solutions, like M&A advisory and valuation services with this integrated, coordinated group of professionals. Because I think a key takeaway here is that none of this stands alone, right? It really all is integrated. And, the ability to bring all of that to bear, for our clients, is something I'm, very happy about, very proud of, and excited to, continue to do for folks. And so, hopefully, everybody gets a chance to interface with, Ryan and Richard, and, look forward to the opportunity to go to bat for all of you, as tax code changes and everything else, and come up with the strategies and tactics that will matter most. So, shameless plug, next workshop coming right up. This is our state of the markets. I'm working on getting some really excellent panelists to join us, some portfolio managers from sort of across the industry. But that's going to be February 28th at noon, also virtual via Zoom. The link will be coming out via email, so just stay tuned over email, and I'll have that out to you here shortly. And with that, I'll take this opportunity to thank Ryan and Richard for joining us. I really appreciate it, guys. Thank you for your help, not just on the presentation, but with all the clients thus far as well. And I'll thank the clients, for your business, but more importantly, for your trust. So thank you. Any other questions, shoot them to my email and we'll get right back to you.
Thanks.
Thanks.
Thank you, guys.